Hello, everyone. Today on the Final Bar, we will talk about this epic, wild ride here on Monday, January 24th. The S&P round tripping from 4,400 down to 4,225 before making all of that back and closing back at 4,400, which is Friday's close. A crazy ride. And if you look at the market at different points during the trading day, you had a very different picture. At the end of the day, ends up being a mixed move, but with an acceleration to the upside into the close. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very cloudy and foggy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the language of technical analysis, using charts, technical indicators, behavioral finance, investor psychology to try to make sense of things. Hopefully, you noticed the new look to the Final Bar. We're back live today here in late January with some new graphics and all sorts of good stuff planned for you through the course of 2022. Wish you all are well and hope you're hanging in there. Given this crazy ride in the market today, this sort of environment, this is a great opportunity to reflect on the difference between the short-term dynamics and the long-term dynamics and making sure that we make long-term decisions using long-term data. It's tough on a day like today where you see a lot of fluctuations. It's easy to try to draw long-term conclusions from short-term fluctuations. Remember, a lot of times the short-term movements in the market are driven by short-term supply and demand. That's when we talk about things like dead cat bounces and failed breakouts and failed breakdowns. These are all instances where the short-term movement will overshoot or undershoot where the market sort of could be or should be based on all available information and based on where buyers and sellers are coming together. We're going to look at some of those long-term charts together today and see what conclusions we can draw. We have great guests on the show. We had a lot of fun last week. I'm thinking of Katie Stockin, the discussion we had on Thursday of last week, and so many more great ones. This week, we have a couple of great guests lined up for you. Tomorrow, on Tuesday the 25th, we have Chris Shavacco from Shavacco Capital in Atlanta. On Wednesday the 26th, John Kosar from Asbury Research. His Asbury 6 proprietary macro model will be very interesting to see what it's saying now, given all the uncertainty we have in the markets. Other announcements to make. Our next episode of The Pitch is going to be airing this Wednesday. I will be moderating that conversation with Joe Rabel, Mary Ellen McGonigal, Jay Woods. Each of them provide 5 stock picks, and we discuss them as a group. It's a lot of fun. Should give you some good ideas about how to approach this market environment. I'm very keen to see what they share with us. Also, a little earlier today, we aired a special event on the Go No Go charts. That's Tyler Wood and Alex Cole from Go No Go charts shared their new ACP plugin and how they use it to visualize market dynamics. So check that out on our on-demand platform or our YouTube channel if you missed it. Let us continue on with today's show. On Monday, we do 3 pieces. We start with the big picture, the market recap. We then go to sectors, and then we look at individual stocks. And the goal is to sort of mirror my own process from what I advocate for a good, normal, weekly, daily process to try to make sense of the market environment. As with many days, I feel like recently the picture changed rapidly during the course of the day. I first started looking at some things early in the morning around 8 a.m. Pacific, around 11 a.m. Eastern, when I really started to dig into the charts after the open, and had one very particular sense of what was happening. And then things completely changed in the afternoon session with the S&P somehow eking out a positive day, closing right above 4,400. And so, a key level like that certainly should be important. We just broke the 200-day moving average and popping back toward it. So we're going to look at some of those charts here in a moment. But sticking with the big picture thesis, the S&P closed higher, just over 0.25%, closing around 4,410. The NASDAQ composite even further up 0.6%. Mid caps finished up 1.8%. Small caps about 2.25%. Now the small caps S&P 600 index was down at 1255 earlier today. Finished actually near Friday's high, just below 1315. So quite a reversal in those days. And again, certainly you're seeing a bid come in. You're seeing buyers come in and buy in the short-term weakness. There's a big move down out of the open. A lot of investors certainly saw that as an opportunity to buy in. The challenge is the buy on the dips looks this way, but also a short-term dead cat bounce before we resume the downtrend. They both look kind of like this until you see what happens next. And that's why tomorrow and thinking about the follow through the course of the week is really, really vital. The VIX, by the way, back higher today. And this is one of those times when the VIX and the S&P don't always move inversely. You had plenty of volatility today, even though we netted out to a positive move. So the VIX is actually up nearing 30. Other asset classes here very quickly. Interest rates actually coming off. This is actually a little weird. I think some of the information might be a little static here. I'm thinking this is oh, I might be right. We'll see. Boy, things happen so quickly. I didn't have a chance to make sense of all these things just yet. But it looks like from the charts, we're seeing the TLT close down. So you're seeing bonds come down, but 10-year yields actually went up a little, went down a little bit as well, just nearing 173. Long bond yields actually went higher. So that could actually make sense. I'm trying to do the mental math in my head and thinking about all these different charts. But certainly, I think we need some time to digest all of this movement going into the close. So yields actually going higher going into the close. That makes sense as bonds would be selling off going into the close. The dollar index using the UUP spent the whole day higher. And the UUP was up about 0.3%. Commodities very much mixed, although gold was up 0.5%. So even though stocks finished higher, gold actually moved higher into the close as well. So another one of those relationships we think is inverse, right? Stocks are going higher, gold is probably weakening because it's a safe haven, and the opposite. You actually saw the GLD go up today, 0.5%. Cryptocurrencies were literally all over the place. And I was watching these earlier. I was chatting with Grayson Rose here at StockCharts about some of the movements we were seeing. Bitcoin actually finished in the positive, which I can barely comprehend how that happened because earlier in the day, it's down around 33,000. We close or where we're at currently as we're doing this show right after the equity market close here on Monday. Bitcoin back up to around 37,000. So talk about a huge reversal. And Bitcoin, Ether, these are great proxies for speculation, right? There's, I think, a good relationship between overall risk appetite and whether individual investors are risk on or risk off, looking at the direction in some of these cryptocurrencies. And you see them obviously going down earlier in the day, but then rotating higher and pushing higher into the close. Ether actually got all the way down to 2,200. Bitcoin, as I mentioned, got all the way down to 33,000. What's interesting, these are back down to some of the major lows from the second half of 2021. So a look at those charts could be a really good idea here, given this rotation that we've seen. Let's see what the chart of the S&P looks like after this sort of crazy day. You may call this a hammer candle. I'm sure some people will. I will tell you it's not the most ideal hammer candle in the world, only because what makes a real classic textbook hammer candle are the open and the close actually being really close to one another, and then limited upper shadow and a long lower shadow. So it literally looks like a hammer. This looks like a hammer with a mallet that's kind of way too big. And while I still would say that the V-shaped move to today certainly suggests short-term optimism, right? I mean, buyers are certainly coming in and buying in on the weakness on stocks. I don't know if I would call this a classic hammer candle. What I will tell you though is the intraday sell-off that we had took the S&P at the end of the session. We had touched 12.5% below the all-time high around 4,800 just a couple weeks ago. So the beginning of January, just about 4,800, we come down and touch around 42.20, 42.30. Then rotate back up, close around 44.10. So on an intraday basis, we got down almost to the 38.2% Fibonacci level, which is at 4,200. We certainly traded below 4,300, which is a key level we've talked about. That's the low from September and October. That was a downside target we talked about. That's that sort of orange shaded area. We traded below that, but did not close below it. So that level of support, in my opinion, has not been broken. It's all about breaking that sort of thing on a closing basis. So long story short, you have the S&P breaking its 200-day moving average on Friday on a closing basis. That also pushes the S&P oversold using the RSI. It's still oversold, but the move higher today certainly suggesting some intraday or some short-term positive sentiment. Tells you about maybe short-term upside for the next day or two would be sort of the classic interpretation of that. Overall, though, we're still in a market that's in distribution mode on the longer-term basis. 4,300, I think, remains the level to watch, that level of support. Do we break it on a closing basis? Has not happened yet, even though it looked likely earlier in the trading day. When we talk about the S&P, talk about some of these measures of risk, and again, most of them sort of V-shaped move to today. Let's keep focus on the long-term trends, keep focus on these key levels. We're still below 4550. We're currently above 4300. Let's look to see which of those levels might break, and that I think will tell you a lot about the potential next move in the S&P. Now that we understand that short-term movement, let's look at the rotation of the 11 S&P sectors. This is our second segment called sector setup. So what we'll do is look at the 11 S&P sectors, how they're moving relative to one another. We're going to start with the RRG. Julius DeKempener here at StockCharts and creator of the RRG graphs designed this visualization years ago. I followed Julius and his work for many, many years and have always appreciated the simplistic way that you're able to understand visually how the sectors rotate. We all talk about sector rotation, which is absolutely the case. The data proves out that cyclical nature to stocks and sectors coming in and out of favor. But this visualization really shows you on graphical format. Now we're looking at weekly data. So this is a great way to take a step back from the craziness we saw today. Think about some of the longer term trends. What it's telling you is overall, the longer term strength is rotating into some of these sectors that are heading northeast, ideally in the leading quadrant. These are the leadership sectors. It's energy, it's consumer staples, it's utilities, it's real estate. Those are the four that are in the leading quadrant that are heading in the right direction, heading northeast. And that's an important distinction, right? The idea that you're heading in that direction means strengthening momentum. The fact that you're in the leading quadrant means you've been outperforming. The fact that you're heading northeast at the time means the momentum is actually continuing to reinforce that stretch of relative outperformance. It's all based on relative strength. So it's telling you energy, consumer staples, utilities, real estate have been the strongest places. We've seen plenty of rotation away from growth, and it's amazing how the FANG stocks actually finished the day mixed. Earlier in the day, they're all down huge, with Netflix really leading the way downwards. Many of them still down, but about 50-50. And we'll look at that a little later in our segment, shifting stocks here. But, certainly a rotation away from growth into value. And while today was sort of a choppy V-shaped day, I still think that is a theme we're going to see a little bit more of. We'll get to semiconductors as well, which actually did pretty well today. KLAC was one of the names that I was looking for as a top performer today. Now let's look at how the 11 S&P sectors on their individual charts worked out through the course of this day. The first thing that comes to mind is I'm looking at a couple of these: technology, real estate, staples hit its 50-day, financials. The ones that I just mentioned, even healthcare, even are ones that traded below their 200-day moving average but closed back above it. And that's always an interesting dynamic, to look for a long-term support level like the 200-day moving average or a Fibonacci retracement level, and then look to see what the price action is when it reaches those levels. So the XLF today opened below the 200-day, traded below it, but by the close had actually gotten all the way back above it. So that's overall sort of an interesting, compelling indication, suggesting, as we mentioned earlier, sort of some short-term demand certainly coming in and buying in on the weakness. Same with technology, right? You traded opened below the 200-day moving average, traded below it, but by the close we got up to 155 on the XOK. That's an interesting one because it also lines up with the low from early October. Technology certainly in the last month has seen a lot of deterioration on an absolute basis, but also on a relative basis. You see the relative give back that you see here as the ratio is going lower and it's underperforming the S&P. Now you have it trading down to established price support from early October. You have it trading below the 200-day, but not closing below it. And with any sort of long-term level of support like that, you'd want to see a close below. That's the first indication that it's really being broken. Trading below it will happen. Closing below it tells you there's enough conviction that going into the close, there's enough follow through to keep the price below that long-term moving average. So again, I bucket everything I just said as short-term bullish, sort of giving you a short-term bounce indication. But long term, I think the causes for concern that we've seen have not evaporated, even given the demand that you saw going into the close today. This is what I would expect, given the dislocation, given the pullback that you saw, certainly in the weakness that we've seen internally, with a lot of individual names down 10, 20+% already, even though the S&P is not nearing that. That's setting the stage pretty well for a bounce like you see on a day like today. Now, a little later after the break, we're going to get to shifting stocks. We'll talk about some of the names reporting earnings this week, because there are plenty of catalysts to see a further bounce to the upside or see further deterioration, see further move to further to the downside. Now, it's also worth noting that some of these defensive sectors, now, again, this day played out in a very interesting, fascinating way, where you saw a lot of weakness earlier, But then closing, by the close, you had sort of a new look to a lot of the individual charts. But it's worth noting some of these longer themes that have been coming out. You've seen utilities start to improve, even though off today on a relative basis, of course, because it's closing down today on a day when some sectors in the S&P managed to get back to the green. But utilities actually outperforming well over the last 2 months. Real estate a little different. Actually, there's a different look to those two charts with utilities. Real estate pulling back a little bit more. The relative strength is more flat for REITs if you look at the last 6 months or so. But it's worth following these sectors because I found people really only tend to own REITs and utilities when they want to get defensive. When you're trying to ride out a frightening part of market uncertainty, that's when you tend to think highly of owning things like real estate, things like utilities, things like consumer staples. Those are more pure defensive plays that you want to hide out in. These are not necessarily offensive plays that we've seen. And we've talked about this relative performance, or staples have been outperforming the S&P. Staples have been outperforming consumer discretionary. And while that ratio sort of mean reverted today, certainly with consumer discretionary outperforming staples, overall, that's been the trend. The trend has been more towards some of the defensive parts of the market. What I will be absolutely focused on through the remainder of this week is what happens, which of these two kind of regains control. You had the bounce today with some of the offense pushing the market back higher. Particularly, we saw consumer discretionary, communication services, and then some cyclical things like energy and industrials, and then technology. So plenty of growth stuff there in the top half. Things that all did fine today, even though the S&P just barely got back above Friday's close. So it'd be interesting to see if you see further upside in some of those sectors through the remainder of this week, given a lot of the earnings pressure we might see, or is it a rotation back to some of the defensive sectors after this short-term bounce becomes confirmed as a short-term bounce and we rotate lower again? We'll try to look at those individual names here in a moment. We'll be back with you after the break. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to be with you live here right after the close every weekday. Make sure you check all of our previous interviews on our on-demand platform or our YouTube channel. A couple quick comments before we get to our next segment, Shifting Stocks. First off, we'd love to hear your questions. We had a great mailbag segment on Friday's show, answering some of the questions you guys have been answering recently. We have a lot more questions coming in. We'll do another mailbag segment on tomorrow's show. Get your questions to us via email, thefinalbar@stockcharts.com, via Twitter @finalbarsctv, on our YouTube channel. Put a comment below the video that you're watching on our Stock Charts channel. We'll gather all those questions and hope to answer one of yours live on the air on Tuesday's show tomorrow of this week. Also, go to StockChartsTV.com. That's our on-demand platform. So much great content. All of our market outlook content from the last couple weeks, all available for you from our website, StockChartsTV.com, or on your mobile device. Just search on any of the app stores for StockCharts TV on demand. Our next segment is called Shifting Stocks. We talked about the big picture, this overall deterioration we've seen, short-term weakness earlier in the day following through from last week, but quite the demand coming in with investor optimism weighing in, and all of a sudden things feel just fine going into the close with the S&P finishing positive. I'm still in a case of disbelief that is how quickly we reversed that V-shaped bottom to the day so far. The final thing we're going to talk about today are shifting stocks. We're going to talk about some of the individual names. A couple things I wanted to highlight for you, because this is kind of a segment where we can talk about a number of different things. First off, it's very interesting to me how earlier in the day, obviously a lot of red if you're looking at individual names, but particularly the FANG stocks, which were all in the red and looked like this was going to continue to accelerate to the downside. You saw quite a mean reversion, and some of these names actually finished up positive. Let's look at a couple of these together. We have Facebook, the best performer out of the six FANG stocks. And again, so what's interesting is if you look at just today, if you look at the surface level, what happened, it's easy to feel really optimistic about a chart like Facebook or a name like a Meta platform. Sorry. You have a stock almost 2% higher on a day when most stocks are sort of mid-range, if that. You saw quite a bit out of the, you sold off to 290, but closed all the way almost to 310. So you gained 20 points back going into the close, returning back to today's open and then even doubling that movement and pushing to the upside. However, I'm still seeing a chart that is a pattern of lower lows and lower highs. And I think this is where it's important to differentiate the short-term movements, what happened today versus what's happening overall. This sort of trend that we've seen in Meta over the last 4 to 5 months reverses not just if you have a day like this, but you have to have a lot of days like this, a sustained demand. Right now, it's more an acute case of demand, to use a medical term, as opposed to a chronic measure of extended demand, right? You need persistent demand. You need buyers outweighing sellers, or buying power overweighting selling pressure is another way to sort of think about that for the stock to turn higher, for the chart to start to improve. The relative strength remains flat, even on a day like today. That bounce you saw where it outperforms is still not really doing much for the overall trend. And I think that's the challenge for this market. A lot of stocks still looking fairly negative, even with the bounce you saw today. Now, the beginning of a recovery could absolutely look like this, and that's why I think you need to pay attention to what might be happening after today. And we'll get to some of the earnings names here in a few moments. Other two names that did pretty well in here, we have Amazon, which was number two. Let's check that out. So, this is a chart obviously that's been on the struggle bus from a that's a technical term for how challenged it's been. You're coming down from 3,700 down to almost touching 2,700 today. That's quite a drop in a name over a 6 8 week period. And what's interesting about Amazon, similar to Facebook, right? You're at the lower end of this range. Amazon's different because it's been in a base for almost year and a half now, for sure, right? Since last July of 2020, really, through the next 18 months, we've been range bound. We've had a couple attempts to break out and break to new all time highs, but both of those attempts over the last 6 months have been repelled. And now you're all of a sudden to the lower end of this range. You're now testing support in a pretty big way around 2,900. That is literally right where we closed. So while we closed just below that level on Friday, today we actually closed above Friday's close. So instead of thinking of this as a broken support level, and the level I'm looking at, by the way, is just this real, I guess I actually use the inspect function. There we go. So if you look at that horizontal line I'm drawing, we're sort of taking the lows from July of 2020, September of 2020, March of 2020. You can see where that lines up versus where we're at today. So we have, basically, I think instead of earlier in the day, this felt like we were clearly breaking support. And you would have heard me at this point talk about aggressive downside targets for the S&P. And I'm not convinced that this downtrend that we are in the midst of is over by any means. I think the market has a lot to prove besides just a couple hours of a rally, even though it was an impressive one. But charts like this tell me that we may hold support. You might get a tradable bounce out of these lows. And again, there's a lot of optimism sort of buried in these charts. There's clearly cash being put to work after we sell off earlier in the day. The question is sustainability, and that's the question for this chart of Amazon. I think the line in the sand has been drawn. It's around 2,900. The question is, do we hold that level? Which, as of today's rally, it looks like we're actually, I think, technically still potentially holding it. Let's see what happens tomorrow through the remainder of this week, and if you see a renewed sense of weakness. Now we'll rotate quickly here over to some of the names that are reporting earnings, just with the time we have left. Couple big ticket items coming up this week. We have Microsoft tomorrow, Tesla on Wednesday, Apple on Thursday, and I highlighted 3 out of about 30 really important ones. I would argue. I think those are probably the main ones that I'm going to be paying attention to. But some of these, like Mastercard, like AT&T, Freeport, Boeing, 3M. A lot of these have really interesting implications for what this tells you about some of these themes that we've talked about over previous months. But let's look at a couple of these in particular. Apple, I think when you look at the chart of Apple versus some of these other charts we look at, you can tell even within the 6 FANMAG stocks or the FANG names, a chart like Apple really stands out as a much more constructive chart than some of these others. I would probably put Microsoft in that bucket as well. While they have all broken some sort of short-term swing lows, so on Apple breaking below this swing low around 165, 170, and we've traded below that. Again, we closed back toward the highs of the day, but still, this is short-term distribution that we're seeing. It's all about do previous support levels hold, and if they don't, where would you get an indication that we're rotating higher? I haven't seen enough to suggest that this is a buyable bounce at this point. This is more a chart that's still closing lower every day, even given the demand that you saw coming in, going into the close here. What's interesting on this chart, by the way, is the high from September is around 157. That was the low from November. And I'll put this little line on here so you can see what I'm talking about. Take that high, that swing high from September, take the swing low there in November. You can see that lines up pretty well with where we're at. That is indicating the concept of polarity, which is where resistance becomes support or support becomes resistance. A price level has meaning, and basically we bounce off of that resistance, and then later we break it and test it as support. I have a video on my YouTube channel called Market Misbehavior. We talk particularly about polarity and look at a couple examples. So check that out if you want more info on that particular concept that we're seeing there in Apple. Going into earnings, certainly this is on Thursday after the close. That is absolutely a catalyst to break support, to break that 155 level, 157 or so. And the 200-day would be the key support below there, as well as these lows from October. I would need to see it get above these previous highs around 180 to be really constructive about long-term resumption of that uptrend for Apple. Now, Tesla and Teslas of the world, and I'm sort of thinking of the ARK Innovation Fund Group, certainly have been struggling. And while this looks like just a nice little range bound sort of sideways pattern after a nice run, these are huge percentage swings. This is like cryptocurrencies where it's very deceiving. This looks like a nice gentle range, but this is going from about 850 where we touched the lows today up to 1250, which is where we had the high in November. So these are huge career busting percentage swings that we're seeing. Right now, it's interesting, of course, with Tesla, we're bouncing off of that support that we had in December. That was around 900. We undercut that a little bit, but closed back above 900. I'd want to see if 900 can hold this week. And again, they're reporting after the close on Wednesday. Microsoft's the last one. This is coming after the close today. This is a key one. We traded below the 200-day, closed back above it. We traded below the October low, closed back above it. That's the level to watch, 280 on Microsoft. They're reporting after the close tomorrow. We need to wrap today's show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number one is KLAC. Earlier in the day, I was noticing how some of the semiconductor names were actually doing very well. KLAC, KLA Corp, which is one of the semiconductor names, finished almost 5% higher. If you look at the SMH, did pretty well and outperformed the broader market. Interesting bullish engulfing pattern here with a nice up day that engulfs the real body from Friday's close. That suggests some short-term weakness, some short-term strength, some buying power going into the close, and suggests a short-term bounce or two. And with this sort of pattern, use the low of today as this sort of natural stop for that pattern. So if we get below 360, that would invalidate that bullish engulfing pattern. But I'm seeing with the demand you saw going into the close today, and some of these bullish patterns, hammer candles and bullish engulfing patterns, wouldn't be surprised to get a bit of a bounce. I think by the end of the week, earnings could be a big part of this. Also, the Fed meeting, we haven't even talked about that yet, coming up this week as well. Chart number two is gold. You saw gold rally, and interesting to remember that just because stocks are up and down does not mean necessarily gold is going to follow suit. You actually saw stocks and gold finished in the green today, with the GLD getting above 170, closing around, staying above 170, getting back above 172 on a closing basis. That's that pink shaded area we've been talking about for quite some time. Last week we got above there. I'd be very interested to see if gold is able to hold it. I would suspect gold has further upside to be had there. I think the sell-off that we've seen in stocks certainly fuels that idea of gold starting to emerge as more of a safe haven than what we saw in 2021. And the strength you saw today, I think, sort of shows that strength. Holding 172 there certainly is an important thing to look for. Finally, and just updating this chart really quickly, this is looking at year-to-date performance of some of these key sectors. The only ones out of the ones I'm highlighting in the positive so far still year-to-date, energy with the XLE up 13.3%. So, it's worth noting that even with all the uncertainty, all the choppiness, a sector like energy is actually holding up just fine and having a decent 2022 so far. Everything else is underperforming or down for the year, but a number of these are actually outperforming, and those are some interesting sectors to pay attention to. When it feels like everything's going down, look for things that are going down a little less. And I see utilities, financials, consumer staples, all able to outperform the S&P 500 so far in this first 3 weeks of the year. Underperforming are healthcare, real estate, and consumer discretionary. And healthcare is an interesting one with some key charts in there. Folks, that's our show for today. Thank you so much for joining us every weekday right after the close, 4 p.m. Eastern here for the Final Bar. Check out all of our previous interviews and episodes on StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.